All right, let's dive into one of the most polarizing assets on the entire planet, Bitcoin. It's at the very heart of this massive financial debate, and you've got brilliant minds on both sides making some incredibly powerful arguments. So, we're going to break it all down.
So, what's the real story here? Is this the next $1 million asset? The new digital gold that's going to reshape finance? Or is it all just a giant speculative bubble, totally propped up by hype and just waiting to pop? That is the core question we're tackling today.
And we're going to look at this head on. First, we'll get into the bull case. That's the argument for a full-blown financial revolution and a price that just keeps climbing. Then, we're going to flip the coin and examine the bear case, the view of a network that's under some immense and maybe even unsustainable pressure. Let's get right into it. First up, let's hear from the bulls. Their argument doesn't actually start with hype or speculation. No, it starts with something way more fundamental, the actual real-world cost of creating a Bitcoin in the first place. This brings us to a really key concept, the cost of production model. See, unlike a stock, you can't just print a Bitcoin. Creating a new one requires real-world resources. We're talking massive amounts of electricity and incredibly expensive hardware. The bulls argue this creates a logical price floor. I mean, miners aren't going to sell a Bitcoin for less than it costs them to make it, right? It gives it this tangible value anchor. And you know what? This isn't just some theory. Historically, this model has held up surprisingly well. For years now, Bitcoin's market price has had this tendency to hover right around its production cost. Even after those wild price spikes, it often comes back towards this fundamental value, which suggests the market might be a lot more rational than many critics give it credit for. And here's the statistical proof. A test was run to figure out which causes which. Does the market price dictate the cost to mine, or does the cost to mine influence the market price? Well, the data strongly suggests it's the latter. This is absolutely crucial because it ties Bitcoin's value directly to tangible, real-world expenses, and it really pushes back against the whole "it's backed by nothing" argument. So, okay, we've got a potential price floor based on real-world costs, but a floor is just, well, it's just the start. For the price to really shoot for the moon, you need demand, and this is where the story gets really explosive. Let's see how that's building up. The big money, the institutions, they're not just knocking on the door anymore. They've kicked it down and moved in. BlackRock, the biggest asset manager in the world, launched a Bitcoin ETF that has sucked in close to $100 billion. And then you have companies like MicroStrategy just going all in, basically treating Bitcoin as a core part of their treasury. This isn't just a bunch of retail hype. This is the financial establishment making a serious strategic play. And even the regulators seem to be getting on board. The SEC has actually streamlined its ETF approval process, cutting the timeline by a whopping 72%. Now, that's not just some little bureaucratic change. That's a huge signal that the doors are swinging open for even more regulated crypto products, which makes it even easier for institutional money to pour in. Now, if we zoom out to the bigger picture, there's a powerful macro-level argument happening here. With things like government debt on the rise and real concerns about inflation, people are getting nervous about traditional government-backed currencies, what we call fiat currencies. They're looking for a safe place to park their money. And, as this quote points out, digital assets are increasingly being seen as that hedge, an alternative that isn't controlled by any single government. So that's a pretty compelling bull case, right? You've got fundamental value, massive institutional demand, and a favorable economic backdrop. But what if the very mechanics of the Bitcoin network itself are creating a kind of ticking time bomb? What if the whole system is facing a major squeeze from the inside out? And that brings us to the bear case. It actually begins with an event that the bulls absolutely celebrate, but one that could pose a really serious threat to the health of the network: the halving. Right, the halving. It's that event that cuts the reward for mining new blocks in half, which makes Bitcoin more scarce over time. That's the bull story. But the bear story focuses on who this really hurts: the miners. The people who actually secure the network. This event literally slashes their revenue in half overnight. And if the people securing the network are in trouble, well, then the network itself is in trouble. This whole situation puts miners in a really tough spot. I mean, they're dealing with shrinking rewards, but at the same time, competition is fiercer than ever. They've got huge energy bills, and they constantly have to buy expensive new hardware just to keep up. For the smaller players, it's becoming a real struggle just to survive. It's a recipe for a massive industry-wide squeeze. And that's not just a business problem. It's a potential security problem for all of Bitcoin.
So the result is pretty predictable: consolidation. We're seeing this wave of mergers and acquisitions, where bigger, more efficient companies like CleanSpark and Hut 8 are just gobbling up the smaller ones. It's like the big fish eating the small fish just to survive and get bigger. And this leads to the most critical question in the whole bear case. Bitcoin's entire value proposition is built on this idea of decentralization, right? But if the mining industry becomes dominated by just a handful of massive corporations, can we still say the network is truly decentralized? This trend threatens to undermine the very principle that gives Bitcoin its power in the first place.
So you've got this intense internal pressure building up on the network. But the risks, they don't stop there. There's another storm cloud gathering on the horizon, and that is global regulation.
This slide really shows how even regulation that means well can be a huge threat. The EU, for example, is pushing for more centralized supervision over crypto. But as this quote warns, that kind of top-down approach could completely throttle the innovation that makes this space so exciting, creating uncertainty and maybe even pushing talent elsewhere. So what we have here are two powerful, completely competing stories about the future of Bitcoin. On one side, you have this revolutionary new asset class, and on the other, a system that's facing some pretty fundamental threats. Let's put them side by side. So here's the bottom line, the real tug of war. The bull case is built on a solid foundation of production costs, a flood of institutional money, and a growing distrust in traditional currencies. But the bear case warns of a fragile system where miners are getting squeezed, the network is at risk of becoming centralized, and the future of regulation is a total wild card. Bitcoin's future really hangs in the balance between these two forces. And now, I want to turn it over to you. After hearing both sides of the argument, where do you stand? Are you siding with the bulls, seeing a whole new financial future taking shape? Or do the bears' arguments have you convinced? Let us know which scenario you think is most likely and why, down in the comments. Hey, if you enjoyed this breakdown, do us a favor and subscribe to The Bull versus the Bear. Make sure to hit that notification bell so you don't miss our next deep dive. And while you wait for the next one, why not check out our analysis of Bitcoin's biggest rival, Ethereum? Just click the link you see on the screen now. Thanks for watching.